though DT implied volatility is always more sensitive to changes in intraday volatility than the 30-day VIX. You have the 1-day and the 30-day up here, and you can see obviously that the 30-day is pretty level-headed, but the 1-day's all over the place.
Significantly more so. About 4x.
About 4x. Okay, makes sense. So 1-day volatility is about 4 times more volatile than the 30-day volatility. Let's go to the next slide. So how can we estimate the value of the close of 1-day implied volatility based on combining 2 variables that we know will affect the index? Where are you going with this?
So we know of a couple things that affect volatility. On a 30-day basis, it's really direction, right? That's the biggest thing. And also, depending on how big the down move is, that's how much volatility will go up on a 30-day basis. But 1-day volatility doesn't have the same isn't affected the same way by price direction as is 30-day volatility. So we're going to see, based on what we know affects it, what's the ratio of the effect of certain variables on 1-day volatility. And we're going to list the variables on the next slide. But it's going to be different. It's going to be very interesting because it's going to be different than what you'd expect. But we're going to give kind of a back-of-the-envelope napkin way to say, okay, well, if we have this in the market, what can we expect to happen to the 1-day volatility?
Let's go to the next slide, Beth. So we did a study. We looked at the SPX and the VIX 1-day daily data. We did this since September of 2022. We created a numerical estimate of the 1-day volatility based on the effects of the SPX daily percent change and the high and low daily range of the SPX. How do each of the variables affect 1-day volatility?
Yeah.
Okay, sounds good. Sounds like a plan. Next slide. So we will use a regression model to construct an estimate of the 1-day VIX. It says blah, 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 blah. And then, no. Would you like to explain this? I can see the little letters here. I can see I can see how you laid it out for us quite nicely, so we can explain it, but go ahead.
Well, so a regression basically takes kind of a very simplified way to look at a variable. It kind of basically condenses the effects on 1-day volatility into basically a limited amount of components. So, everyday people can say, oh, okay, 1-day VIX is affected by this and this, right? This example here is just showing if we're going to estimate 1-day VIX based on one variable. But in this study, we're actually going to do 2 variables. So the actual equation is a little bit longer. But what we're basically doing is we're taking the base effect, which is like, what's the base value for volatility? And then we're going to combine, okay, this variable, which is the percent change in the SPX, what is that effect on the 1-day VIX? And then we're going to look at the range of the SPX on that day. What's that effect on the 1-day VIX? Add them together, and we're going to get the estimate for the 1-day VIX. And we're actually going to compare them to what actually happened to see how good is it, actually.
Okay, let's go to the next slide. So from the regression model, we get the following estimation formula. We take 10, the base value for the VIX 1-day, less 50% of the daily SPX return, and then add 15% of the SPX range. I don't understand.
So basically, what we found is that the 1-day VIX is actually significantly more sensitive to the range that the S&P has, more than the actual percent change or the directional percent change that the SPX has. So, and this kind of makes sense because a lot of these 1-day options or 0-day options, they're really priced based on the expected range up or down. It doesn't really matter if the market makes a big down move or an up move because they expire tomorrow anyway, right? So the real kind of risk factor is the actual range that the market has, because that's what can make or break a butterfly, as an example, right? So, if we look at this formula, if let's say the SPX changes, 0.5%, or let's say changes 1%. So SPX goes down 1%. We're going to have some bump up in the SPX in the 1-day volatility, but it's going to be a fraction of the effect that the range itself has. So like if you have a range that's 100 points, that's going to add about 15 points to the VIX 1-day, as opposed to, let's say we have a 2% down move, it's going to add about 1 point. to the 1 day volatility. And
wouldn't the 1 day volatility be greatly reduced because it is 1 day volatility and there's no overnight risk?
well, no, there is overnight risk. The 1 day volatility looks at tomorrow's options.
Oh, okay, all right.
Yeah.
So you look at, I'm sorry, yeah, you're not looking at zero, you're doing the 1 day.
Right, exactly.
Got it.
So this is basically saying, okay, if the SPX changes by like 2% and the range today was 50 points, what should we expect the 1 day VIX to be at the end of today? And what we know is, and this is kind of intuitive, right? 10 is kind of the base value, right? If we have no movement and there's like a very small range, we should expect the VIX 1 day, right? If the rest of the values are zeros, there's no movement and there's like no range, we should expect the VIX 1 day to be around 10, right? And that's what we see, right? We saw in the last few weeks, basically, when there was no price action, there was no, big moves, that the average value was 10. So that's kind of the base value. But now, as you get larger daily ranges, you're going to see that value go, to 12 to 15 to 17. The last 2 days were actually a very good example, because yesterday we had a very weird day where we were unchanged, but we had a very big range. And the 26th, the day before, we had a day where we had a big day, a big change, and a big range. Mm-hmm. So we can actually, and that's what we're going to compare in the next few slides, how well does it actually stack up to what actually happened? We're going to see that the VIX 1 day doesn't really, the actual percent change of the SPX doesn't actually have that much of an impact on the VIX compared to the range effect. We'll see in the next few slides.
Let's go to the next slide.
Don't ruin his thunder, Sosnov.
I'm not. This is hard for me.
No kidding.
It actually is hard. Testing out September 26th, 2 days ago, we find an estimated value within 1 point of the actual value. So you went back, you back tested, and it came out that close.
Mm-hmm. Yep. And it's interesting because when we have...
that was a crazy busy day, wasn't it? That day they moved like 60 or 70 points.
It was 70 points,
Yeah.
but the actual daily range was 47, right? Because we basically gapped open lower.
Yeah.
So the range was 47 points. When we plug the numbers in, we actually get 17.8 as the estimate, but the actual number was like 17. So you're going to have some margin of error, as you always would. But the two main variables are still the range and the price direction. The key takeaway of the segment, though, is the 1 day VIX isn't as sensitive to the percent change as it is the range. Like, for example, we have a 1.5% change to the downside, right? That's a pretty big move. But the factor, that's only 50% of that. So it's like 75 cents, right? So even if we had a 3% down move, right? The reason why the VIX would expand isn't because of the actual 3% down move, but it's because of the range, right?
Got it.
And the reason for that is because if it went up 3%, you probably would have had an expansion too. That's something we don't see in 30-day volatility, is that a big up move in 30-day volatility would actually cause a decline. For 1 day VIX, it's actually pretty common to see an increase in volatility, even if we have a big up move, because now we have a larger expected range.
That's really interesting. Let's go to the next slide.
Good job, Anton, so far.
So testing out September 27th, the next day, which was an unchanged day, that was yesterday, which we did close exactly unchanged, with a large range, we find the estimated value was even closer to the actual value. Yeah, it's amazing.
Yeah, so this case, we have a zero effect on the percent change part. But again, the range is what makes most of the volatility, right? And this kind of makes sense because, if you think about this, if you kind of compare this in your mind, let's say the range was like 10 points, a very small day, VIX 1 day would be approximately 11. And that's what we've seen in the last few months when there was not much of a range. We saw the VIX 1 day at about 11, right? Sometimes even 9, right? And again, this is going to have some margin of error, but the fact of the matter is it's uniquely different from 30-day volatility because the range of today actually matters for the VIX value today.
Super interesting. I never really thought of it this way. Mm-hmm. Let's go to the next slide.
Man, you're good.
Takeaways.
That's color.
The largest determining factor for the 1 day VIX is the range of the market rather than the actual daily percent change. Yeah, I mean, when you think about it, it totally makes sense. I just never thought about it that way. Mm-hmm. Yeah, sure, it should be the
Maybe
range.
it's about time you start.
It should be the range. What does it have to do? Who cares about the actual daily percent change? And the quickest way to estimate the SPX range effect 1 day volatility is to take 10 plus 15% of the daily range. Okay? Came up with a nice little formula. Mm-hmm. And then since we want to trade zero DT trades when one-day VIX is close to 20, we should expect the SPX to have a range that exceeds 60 points.
So the reason for that third takeaway is because when a lot of people see volatility come back into the market, I think the natural reaction is to kind of get like, oh, how can I buy a butterfly when we just had like a 60, 70 point move? But the thing is, those ranges are very basically integral to have a high one-day VIX. And if you want to trade these butterflies in high volatility, there's no way around getting around the fact that you're going to have a big range. So the fact is that when you have a big range, this segment should hopefully quell those fears and say, listen, if you want to make money in those butterflies, like back in March, April, when you could make money on them, the reason you could is because the range that we had every day was like 60, 50 points, right? The 50, 60, 70, even 100 points we saw. But that's when volatility is high. And that's, you're basically expecting to see the range is high when the one-day VIX is high, and that's when you're going to be expecting to trade those butterflies.
So if a range is 60 points, you're taking 15% of that.
Mm-hmm. It's about 9.
Adding 10.
19.
19.
And that's exactly what we saw back in April, May, and June.
Pretty good.
You're amazing. If you weren't taken, Tony would take you.
Yeah, for sure. We're going to take a quick 90-second break and come back. We got more Tasty Live after this with, oh joy, Mr. Scott Sheridan, Tasty Trade World Headquarters. We'll be back in 90 seconds.